Good morning, I'm Bill Hubbard, Chief Economist at Trade.com, and welcome to our weekly market analysis here on Core Finance. And having the courage to show up this morning, we got the Chief FX Strategist, Jeremy Stretch from CIBC.
Good morning, Bill.
Well, it's been a very interesting 24 hours, first with sterling and then with the dollar. So where do you stand now on the Bank of England / sterling? And as we see, we've got, unfortunately, this is 2 days ago when it was still well above 136. On sterling, on Boris Johnson, Theresa May, et cetera, et cetera.
Well, there are certainly many moving parts, let's put it that way, to the sterling story. I mean, obviously we have the Bank of England, as you quite rightly say, which has clearly changed the dial in the wake of their rhetoric at the back end of last week. Although Mr. Carney did dial back a little bit on that on Monday when he was in Washington, underlining the fact that moves would be slow and gradual, talking about the risks a little bit more, which just added a bit of a grist to the mill that Carney has that tendency to be an unreliable boyfriend, as he was notably quoted upon by an MP in a Treasury Select Committee hearing. So clearly the direction of travel in terms of the rate expectations have moved up and provide sterling with some support. I'm still rather agnostic as to whether I should rush into pricing in a hike as early as the next meeting in early November, because the considerations or the variables that the bank have been pointing to in terms of the erosion of spare capacity, well, the economy is running below trend. Elevated prices, well, prices are just about to peak, and/or the absence or the suspicion of wage growth. Well, the anecdotal evidence suggests otherwise, and certainly the Bank of England's agents report, which came out at the same time as retail sales yesterday, painted a rather more sanguine outlook for the economy.
Again, the last time we were together, I know we were talking about my very good friend George Buckley at Nomura, who seemed to be the only person in the world who was expecting a rate hike in August. Now, I will have to say I've gotten more towards his camp, and I think Credit Suisse has now come out. But I'm like you. I looked more at the agent's report yesterday, okay, rather than the retail sales number, and that wasn't as glowing.
No, indeed it wasn't, and I think that's where sometimes markets get a little bit blindsided. The bank, I think, do take relatively great store by their agents, and the whole point of having those agents is to get that anecdotal evidence from on the ground, and clearly that was not quite as robust as the retail sales report would suggest.
Okay, the Bank of England, I think, what are there, 80 of them that go all over the country and knocking on doors, and it's very similar to the Fed's beige book. So it gives the people at the Bank of England, as it does with the Federal Reserve, what the man on the street outside of either Washington or London is really doing.
Absolutely, and I think that's always been, or always has been, a risk in terms of financial markets. You tend to overemphasize what's happening in the main domicile, i.e., London or New York, and then extrapolate that across the rest of the nation. Now, clearly, the rest of the country is very different to London. We've got obviously a very different structure of growth or growth composition regionally, and so those agents' reports are important. And I think that reduction in sentiment or the moderation in activity or concerns about the growth outlooks do need to be read in that particular context. So that, to me, suggests the balance of risks in terms of what the bank are considering doing do not, in my opinion, warrant that immediate hike in November. And I think it's fascinating because, of course, we do get a couple of key data points before November the 2nd. We get another round of wage data, we get another round of CPI, and also we get the first stab at the next quarter of GDP. And as I say, the bank, we're talking about the erosion of spare capacity. Even though they've reduced the trend rate of growth in terms of their assumptions down to 1.75%. I'm not sure that the economy is running on an annualized basis at those sort of levels.
Well, one of the things you just mentioned, Jeremy, was economic statistics. Well, in about 24 hours, Mother Teresa and co., whether that co is Boris Johnson, Philip Hammond, et cetera, she will be delivering a major speech, in Florence. And it's been quite interesting. Most of the people with Boris Johnson's 4,000-word plus, treatise on what real Brexit should be in the Daily the Daily Mail last week, and then her speech last night saying that, they hope that her speech has probably been written in pencil, and there are probably about 500 different changes are changed. Tomorrow, how much of an influence has Boris Johnson's, let's say, antics since last Saturday predicated sterling going to 132 or back to 138?
Well, I think it is hugely important. The UK cabinet are agreeing that speech in terms of its text almost as we speak currently. So the cabinet itself has not seen the underlying dynamics of Prime Minister May's speech until almost 24 hours before its delivery, which I think, in a sense, either underlines its unprecedented nature, or also underlines the real sort of dilemma that the Prime Minister has in terms of trying to pitch this process. Now, of course, we've seen those leaks suggesting that the Prime Minister will be intent to offer the European Union facilitation payment of maybe 20 billion euros in order to try and unlock the logjam of the negotiation process between the UK and Europe. And I think that's really what she's trying to do. She's trying to refocus the negotiations, moving away from those direct negotiations between David Davis, the Brexit Secretary, and Michel Barnier, and perhaps going above the heads of Barnier to the national leaders' heads. Now, I think that's an interesting strategy. I'm not sure it's going to be a workable strategy, but the Prime Minister really wants to try and advance the case for discussion of the trade deal at the EU Leaders Summit on the 19th and 20th of October. Because, of course, the longer that trade deal remains on the sidelines rather than being discussed, the greater the risk that sterling goes back to 132 than stays at 138. And I think in terms of the context of euro sterling, for example, the substantial correction that we've seen, I think certainly if we get to levels back to sort of 87.5, provides good levels to buy back in again, because I think there is still sufficient risk on the UK side to warrant buying sterling.
We were around 135. Let's go to the euro dollar. Now, as you just said, this is the key. It's not so much euro dollar as euro sterling. And I know we were flirting with 90-ish. And then, of course, we had a massive drop, especially after the Federal Reserve's statement last night. You know, we were trading at the low 88 level. So you think that, are we getting close now to another buy?
Indeed, I think in some context of euro sterling, yes. I think if we see levels around sort of 87.40, 87.50, then I think that's a good buying opportunity. I think we will see sterling rallying back up towards that 90 pence threshold and probably a little bit higher than that into the end of the year, because unless the UK can unlock the trade negotiations, then I think UK PLC is going to find that it is going to be rather more challenging environment, irrespective of the debate about UK interest rates.
So, I mean, as we saw last night after the Fed, we were for euro dollar, 118 plus rather than a 120 plus. So that will at least be a respite from the ECB speak in reference to they're getting concerned at 120. But as I say, I think most of our viewers should be looking, as you say, euro sterling rather than euro dollar. And I haven't seen anybody change their opinion except maybe moving it down to maybe 92, 93 by year end. Excuse me, we may not see 95 until the middle of next year. But I don't see anybody saying that the rally's over in euro sterling right now.
No, I don't think that's true. And I think it is just a case of just adjusting near-term trading targets just because of the valuation changes. I think the direction of travel is still very well worn, and I think that will continue to play out into next year.
Well, as we saw last night, were you surprised, shocked? Did you expect exactly what we got from the Federal Reserve?
Not shocked, but a little surprised in a sense that the Fed maintained the 3-dot projection for 2018. We were assuming that they would maintain the hike for this year because that's our base case view, that we think that the Fed will follow through. But in the light of the presumption of a lower inflation profile into next year, which the Fed have pushed through, then we thought there was a risk that the market, or that we were in line with the market, we're assuming that there may well have been a risk to see those 3 dots dropping back to 2, and hence the market went in short dollars. And so we saw a substantial short squeeze, both in the dollar and also in the US fixed income market. Now I think the question is, we're now reassessing the outlook from here, and I think what markets perhaps ignored was the longer run outlook for Fed funds. That was revised down slightly. So I think what the Fed are trying to do, and of course we don't know whether Yellen will be still in control of that Fed, what the Fed is trying to do is to say, well, we're getting towards what we would consider a more neutral position relatively quickly by still pricing in that 3 hikes in 2018. But beyond that, it's going to be a very much slower pace of activity.
Because, I mean, one of the things that we've seen, I mean, we were, this time last week, we were talking about maybe high 40s prediction for the 12th, 13th of December. I mean, now I think last night after the Fed, it's 74%. And one of the things I think that we have to keep looking at, and the people that are now becoming bullish on the dollar, now that we know the plan that they outlined on the 14th of June about, the reducing the $4 trillion. But one of the things, and I think this is important, maybe just because I'm a bond man talking about, with all of this coming back, I know that I think the 10-year now is 2.27, okay, which is a 100, 200-day moving average. But talking, after maybe 6 months of that, we could see the 10-year back. I know Bill Gross was talking about this 3 years ago at the 3% plus, feeling when that happens, we then could start seeing a massive inflow of dollars buying the Treasury market. Would you agree with that?
It's entirely possible, but I think getting towards 3% is it feels like the holy grail. I've been and visited investors at the beginning of probably the last 3 years, and we've been talking about bond markets and bond yields, and everybody's been talking about, well, is this the year that US 10s are going to go to 3%? And we get to probably the end of Q1, and everybody starts to throw in the towel. And so, in a sense, I think there is still that mentality. I think there is a risk that we continue to see the bonds sell off and we see yields moving back up. But I think getting back to the sort of 260 level is probably more feasible than necessarily getting to 3%. So I don't think we're going to get to the sort of levels where the US yield attraction is going to be sufficiently large to warrant significant dollar inflow. So I think in the context of where we are now, then I think we've got the market which has been forced to reprice a little bit expectations for the December Fed, and I think a market that was overly short. So I think the dollar will have probably a better fourth quarter than it's had for the last two quarters.
Well, let's see.
But it is only a better quarter. It's not reversing the
key thing
trend.
that everybody's been looking at is dollar yen. Buy at 107.5 and sell around the 114 level. Well, all of a sudden, as you can see what happened here. And we shot up, and I think we were like 112 plus last night. Now, again, the Bank of Japan did nothing. But now, how much higher or lower, depending on which way you're looking, 112, 113, 114, before the Bank of Japan gets somewhat concerned?
I don't think the Bank of Japan will get somewhat concerned if we're heading up above those peaks in the 114 areas per se, because of course the Bank of Japan is inherently determined to reach that 2% inflation target. And indeed, not only did the Bank of Japan keep policy on hold, but there was a dissenter, and that dissenter was arguing the bank weren't dovish enough. And that's that's a real sea change and emblematic of the way that Abe has now packed the Bank of Japan with doves who vote in his own image, as it were. So I don't think the Bank of Japan will be particularly concerned by 114 or even higher.
Yeah.
I think the converse would be, of course, that the US may become a little concerned if dollar yen is roaring through 115 and beyond, because of course that has implications for trade competitiveness, and you're suddenly getting back into the debate about what's the comparative level, what's the situation which is giving Japanese exporters a comparative advantage over domestic producers. So I think that's probably more of the variable. But we've seen dollar yen moving up very smartly in the aftermath of the Fed. We've taken out the 200-day moving average. As long as we can sustain that level in the low 112s, then all things being equal, and of course that's geopolitical risks notwithstanding, then I think that uptrend in dollar yen is probably going to persist a little further. And I think one of the favourite trades that we've been looking at for some time has been short yen in terms of the crosses, and I think that's still a story that's going to be perpetuated.
Yeah, because as you say, I'm the same way. I like dollar yen and I like euro yen, feeling it's more of a yen story than right now a dollar or euro.
Well, exactly. If you're looking for a funding currency, then inevitably all eyes are taken to the direction of the yen, because of course if we're talking about any number of central banks now thinking or moving in the direction of monetary policy tightening, the Bank of Japan stands in almost splendid isolation. Now, the BOJ are probably not particularly averse to that, because, of course, if we are going to see the yen used as the funding currency, then that's going to keep the currency on the cheap side of fair value or cheap side of equilibrium, and that will provide some imported price stimulus to help the BOJ attain their CPI target.
Just to make sure that we love you, being a Canadian bank, let's look at very quickly the Canadian dollar right now.
Well, Canada has been fascinating because, of course, we've seen investors rushing from one side of the boat to the other in terms of the way they've been positioned because of the inherent dynamics of the Bank of Canada. We've seen not only the bank adjust their rate profile, but then follow that through with two hikes, I should say, reversing the emergency stimulus that we saw in 2015. Now, in a sense, I think the markets have got themselves bulled up with the presumption that we've seen two hikes, so surely the bank will follow through with an additional hike before the end of the year. And indeed, we've been running where 2-year yields have been running higher in Canada over the US. The probability of a December hike from the Bank of Canada was higher and has been higher than the Fed for some considerable time, and that's really driven the Canadian dollar to extreme levels. But when we had those comments from Deputy Governor Lane at the beginning of the week, he did make some reference about the currency. I think the data into the second half of the year will not be able to match the momentum that we saw in the first half. And I think the combination of those two factors in a market which is possibly overly long does suggest that the Canadian dollar may struggle a little bit more in terms of the second half of the year, or certainly into the fourth quarter of the year, I should say. So I think we are likely to see dollar CAD giving back some of its downside impetus, and I wouldn't be surprised if it's trading back towards sort of 126 into the end of the year.
Well, Jeremy, thank you very much.
Pleasure.
Have a lovely weekend, and I know we've got Theresa May tomorrow, and then of course we can discuss this the next time. Angela Merkel on Sunday. So, Jeremy, thank you very much, and we'll
Thanks very
see
much,
you
Bill.
next month.